Welcome back to the Digital Asset Report. Bitcoin pushed back above 70,000 this week as geopolitical tensions eased and risk appetite returned across markets. Ethereum also moved higher and the broader crypto complex followed. The move was tied in part to improving sentiment around Middle East conflict risks, which had pushed oil prices sharply higher earlier in the week. The whiplash on oil has been real as prices have swung from 120 to 77 and then back over 90 this week. Meanwhile, Bitcoin has been resilient, closing last week green for the first time since January and moving up while other assets have a choppy week. But price action is only part of the story. The bigger development this week is happening inside the infrastructure of financial markets. Nasdaq announced a new partnership with crypto exchange Kraken to build infrastructure for tokenized equities. The goal is to allow blockchain-based shares on public companies to trade with the same rights as traditional securities, including voting and dividend distribution. The project aims to enable 24-hour trading and faster settlement while preserving the existing market structure. Take a listen.
I think that leads to the next big story happening at Kraken that was just announced earlier this week, which was a partnership with the Nasdaq to offer tokenized stocks, which I think is the biggest buzzword in crypto right now, maybe besides stablecoins. Obviously, we've seen the New York Stock Exchange move into this. This seems like this is going to be a competitive alternate route going through the Nasdaq. So can you talk about what this launch was, what you're moving toward?
Does tokenization compete with traditional exchanges? Is this a new route to trade stocks outside of traditional markets? I think this is what typically people will think about. And then why is the Nasdaq even involved if crypto is supposed to disrupt? I would take a step back and I would frame this as not an alternate route to traditional markets. It's really an extension of market infrastructure that already exists. That's one. Two, Nasdaq built one of the most trusted and efficient market infrastructures in the world. We're all used to it. They came in the 70s to trade this out. It's very similar to what you're seeing in crypto, just a different generation. And what we're doing together with them is connecting that regulated market infrastructure with programmable digital asset infrastructure. Okay, what does that mean? So what does tokenization allow you to do? It allows equities to exist in that digital instrument that can move across all of these blockchain networks that's interoperable while still preserving the underlying rights and regulatory protections of a traditional market, which is what a lot of people have been discussing. So the goal is not to bypass the exchange or market rules. It's allow those assets to operate in more continuous and globally accessible financial systems.
The proposal goes further than earlier tokenized stock experiments, and this model tokenized shares could carry the same identifiers as their traditional counterparts and settle through existing systems. That means the blockchain layer becomes a new distribution and settlement rail, not a separate shadow market. If implemented as planned, the infrastructure could open tokenized equities to global investors while maintaining regulatory oversight. Traditional exchanges are preparing for a hybrid market structure where securities can exist both on-chain and inside legacy clearing systems. Meanwhile, in Europe, asset management giant BlackRock is signaling continued demand for digital asset investment vehicles. The firm said its European Bitcoin exchange-traded product attracted about $835 million in inflows since launching last year. That performance is part of a broader expansion across digital asset products and active ETFs in the region. BlackRock already oversees more than $1.3 trillion in ETF assets in Europe and is positioning digital asset exposure as part of the mainstream ETF toolkit. And that expansion continues. This week, BlackRock launched its first staked Ether ETF on Nasdaq, its third crypto fund and the first to incorporate staking. The fund holds spot Ether and stakes a portion of its holdings, letting investors earn staking rewards alongside price exposure. It's a notable step since the first wave of spot Ether ETFs launched without staking, keeping some crypto-native investors on the sidelines. And in other news, stablecoins remain a central policy debate. The Bank of England said it's open to revising proposed rules for systemic sterling stablecoins after industry criticism. Earlier proposals would require issuers to hold 40% of backing assets as non-interest-bearing deposits at the central bank and impose limits on holdings. Officials now say those requirements could be adjusted if alternative approaches meet the same financial stability goals. In the United States, regulatory clarity may be closer than many expect. CFTC and SEC leadership both signaled on the All In podcast this week that their agencies are ready to implement crypto market structure rules as soon as the Clarity Act becomes law. The CFTC would gain broad authority over spot markets under the legislation, and they're already prepping the framework.
A big piece of my agenda has been crypto, our crypto asset markets. As you all I'm sure tracking. There's some legislation that we're really hopefully working with David Sachs to get across the finish line and the president, but that's going to be a key piece. So the CFTC would have a broad amount of authority over the spot markets, and we're getting ready to implement those rules should the legislation get across the finish line.
That momentum isn't limited to the US. Several of Europe's largest economies are pushing for centralized supervision. The broader policy direction remains clear. Governments want stablecoins integrated into regulated financial systems, but only with strict safeguards around reserves, liquidity, and redemption rights. Elsewhere in global regulations, several of Europe's largest economies are pushing for centralized supervision of capital markets across the European Union. Finance ministers from Germany, France, Italy, Spain, Poland, and the Netherlands back stronger authority for the European Securities and Markets Authority, including oversight of crypto asset providers and cross-border financial infrastructure. The proposal is part of a wider effort to unify fragmented European capital markets and strengthen the euro's role in global finance. And in Asia Pacific, Ripple is expanding its regulated footprint. The company acquired an Australian financial services license through the purchase of BC Payments Australia. That license allows Ripple to offer regulated transaction services and settlement connectivity for Australian clients. It also helps address the persistent problem of banking access for crypto firms operating in the region. Taken together, the week's developments point to a clear pattern. Exchanges are designing tokenized equity rails, asset managers are expanding crypto investment vehicles abroad, regulators are refining stablecoin frameworks, and major payment networks are securing licenses inside traditional financial systems. Crypto rails are getting finalized in real time. That's it for today. If you enjoyed this video, be sure to give us a like and follow along for more.